Hey, it's Dario and this is Coffee with the Markets. And today I wanted to talk to you about an article I was reading about the Gen Zers wanting to buy more houses in the future. Of course, the Gen Zers are the people born between 1996 and 2012, so not all of them can really buy a house, and not many of them actually have a house right now. But this article has made a study to make a comparison between Gen Zers and Millennials to see actually if Gen Zers are more likely to buy a house in the future. Some days ago I was also reading another article about millennials instead, and they were saying that millennials are now starting to buy less houses because they prefer to rent, because it's cheaper for them, because they can move more easily, and so on. But I wanted to talk to you about the Gen Zers because not only they want to buy houses, but they are actually saving to buy those houses, and that's something really impressionable, because the article says that for example, Gen Zers are twice as likely to be saving for a house before the age of 25 compared to the millennials. So that's something that I actually am really proud of. I'm actually a Gen Zer. I was born in 1999, so actually I am a Gen Zer, and seeing that my fellows are actually saving, at least in America, this is a study in America, in the USA, so actually saving for houses, it's something I'm really proud, okay? I'm really proud about that. Because again, seeing millennials that don't want to buy houses, and also seeing that millennials didn't actually save as much to buy houses back in the days when they were younger compared to us, it's something good, I think, because again, we can see that financial education is probably growing, but also not that, because the study also tries to give an explanation why the Gen Zers are saving more than millennials did back in the days. That's because of the Great Recession in 28, and also because other events that shaped the economic system and made it harder to live, and to see that people need to save, because when it comes to something like the Great Recession in 2008, you're not going to have money to buy bread, to buy water, to buy basic things, and that's why Gen Zers are more likely to be saving at a younger age. Okay, so the study has been done with people from the age of 18 to 24. Again, we don't have many people, and also we have young people and people who don't actually buy houses, who don't live by their own, who have time to save, who have the opportunity to save. But yeah, I'm really proud, and also at the end the study says that hypothetically, if you gave the money to a Gen Zers now, something around 5 grand, they would rather save it for a down payment for a house than spend it. And that's something that I am really proud. I don't see that much reflecting in our society where I live with my fellows, but knowing that at least in the USA, at least from the point of view of this study, of course this study doesn't study all Gen Zers, it's great. Okay, I will just leave it there. It's great. Yeah, I will put a link for the article in the description. Have a look at it. It's really nice, and seeing that there is the future, there is hope for people actually starting to save and to acknowledge what saving is and investing is, because also they say that buying a house for them would mean an investment, and that's really true. Also, today I would like to talk to you about Deutsche Bank, because they passed the stress test in June from the Federal Reserve, and that made a little run for 3-4 days, but guys, be careful. I just wanted to point out this thing because the Deutsche Bank has passed the test. The Deutsche Bank is cutting job places. The Deutsche Bank is restructuring their management, but that's not enough. If we go and see, I use Simply Wall Street to see this. If we go and see the fundamentals, we are still in negative for the earnings. We have decreasing revenues, okay? And that's something that I see. We see something that I really don't like, the fact that the short-term liabilities are not covered by the short-term assets, and that's bad, okay? If something happens, the bank is screwed. We have cash going down, we have debt going a little bit up, and so what I want to say is that the fundamentals are still there, and the fundamentals are crap. the bank, it's not alright, okay? It's not doing so well, and the fact that they passed the stress test of Federal Reserve doesn't mean that they are now good. And the fact they want to restructure, it doesn't mean that they are good. Probably they want to restructure, to lower the cost, to lower the value of the company in order to be bought by someone else. So actually be careful. And I'm watching also the chart on the 90, okay? And again, what do we see? We see a company that falls, that keeps falling. And what I said in the video of the guy who lost $342,000, that if the price of a stock is going down, it's probably going to keep going down. The price has to be high in order to be bought, because that means that people are willing to pay more for that company. When the price goes down, it means that people are willing to pay less and less and less money to buy the stock. On the other hand, the sellers are willing to sell at lower and lower costs to get rid of the stock. So think about that, and yeah, be careful, okay? Now let's go just quickly and see the Nasdaq, because we saw the Nasdaq last week, okay? And we said that the Nasdaq was breaking. It actually broke the highs, and I'm really happy for that, okay? At least the technological sector is going on the right way. Again, be careful. A break doesn't necessarily mean a 10 years bull run, okay? Just be careful about that, but it means a great thing, okay? We broke the highs, we are at new highs. I'm still watching the QQQ ETF, okay? We are still at new highs. If we watch the volume, we had a good increase in volume for the break, and that's fine. I mean, that's good, not even fine. We had a gap for the break, and that's even more better, okay? I don't know if you can say more better, but it's better, okay? And yeah, also the S&P 500, again, the SPY ETF, it's the same. Actually, it's even better because it started to grow even faster. Also here we have a good amount of volume for the break, okay? And that's fine. We also have a gap, and that's really good. We are at new highs at 365 cents on the ETF again. So yeah, that's really good. I'm really happy for the US markets, a little bit less for the Russell 2000, because again, we talked about this the last week. It's still lateral. I'm probably going to show you a graph, but again, it's the same as last week. It's still struggling. It's going to keep struggling for at least 2019 from my point of view. I mean, there is no chance it could have a bull run so fast to break those tops from my point of view. And if the Russell 2000 would have that kind of bull run, I wouldn't really like it. Also, the stock of the week. Again, we go for the stock of the week, which is Radian Group. The ticker is RDN. They are based in the US where they work, and they are in the real estate market. They mainly give insurances and mortgage insurances to people, companies. So it's a financial company. So it's on that sector, finance. Okay, the finance sector, it's going pretty fine, I would say, compared to the S&P 500. If you watch the relative strength, it's a little bit lateral, okay, the relative strength line compared to the S&P 500, also compared to the Dow Jones US market. It's a fine sector, okay? It's not the technological sector or the service sector, which are skyrocketing compared to the S&P 500, but it's a fine sector, okay? It's a fine sector to invest in, and the Radian Group is doing even better than the S&P 500, and also even better than the financial sector. That's something that I always want to see. I want to see the stock beating the market of reference, and that's something I want to see. Also, we have a good increase in revenues and in earnings, and that's really fine. You know, I want growing companies, and so I see a really good increase in revenue and a really strong increase in earnings. Also, we have a decent ROE, over 15%, and also it's nice that it's over its market, the mortgage sector. Okay, the simply what's it's comparing to the mortgage sector. We have the short-term liabilities completely covered by the short-term assets, and that's really good. We have a debt that is controlled. It's lateral debt, so it's pretty much controlled, and that's really good. Okay, on the technical side, it made a lateralization, it made a consolidation. I don't know if it's actually going to break, but if it breaks, it's a good buy for me, from my point of view. But again, this is not an advice. do your own research. I'm not saying that you have to buy it, just have a look at it and tell me what you think in the comments. But hey, this was all for this week. I hope you enjoyed the video. If it was like that, please leave it a like and let me know in the comments down below what is your stock of the week. And I'll see you in the next video. Hey, it's Dario and this is Coffee with the Markets. But what coffee is this? Yeah, I made a Stefan Graham iced coffee. But even speaking just about Minecraft, we thought that Minecraft was dead. Well, it's not that dead. It's coming a new trend. We have seen it on YouTube videos, for example.